Welcome to the Ellsworth Advisors monthly update. I'm Kelly Keenan. This is Cameron Mealy. And today we're going to talk about how things played out in August, how our portfolio has performed, and then talk a little bit about what we expect coming down for the next couple months. Hope everyone had a great Labor Day weekend. And Cam, why don't you kick it off with some economic numbers?
Thank you, Kelly, and good afternoon, everybody. Hope everybody is well out there. Let's start off with GDP. It's kind of the first number we always hit. On August 30th, the Bureau of Economic Analysis reported that, according to its second estimate, second quarter GDP increased at an annualized rate of 2.1%. This is slightly down from the 2.4% that they reported as their advanced estimate. And it's pretty much in line with the first quarter, which was at 2%. So, from a GDP standpoint, the economy is kind of right where the Fed wants to see it, where traditional, healthy growth for the large U.S. economy is right around that 2% area. If we look at employment, we've had some great employment numbers in 2022. We've seen a little bit of not really weakness in 2023, but kind of a reversion back to the mean. On September 1st, the Bureau of Labor Statistics reported that the U.S. added 187 jobs in August. This was slightly above the consensus estimate that was 170,000. But what's interesting is the Bureau of Labor Statistics also announced a major revision to the 12-month period ending March 2023. They brought that cumulative jobs number down about 306,000 jobs. And essentially, when you add that in, the unemployment rate in August went from 3.5% to 3.8%. So technically, we are seeing a little, you can call that weakness in the job market.
Softening weakness.
What's interesting is we've now gone from average monthly job growth in 2022 was about 400,000 jobs per month. We're now running at about 258,000 in 2023. So certainly a little bit of softening in the jobs market. Other big number that came out, inflation. On August 31st, Bureau of Economic Analysis reported that the Personal Consumption Expenditure Price Index, which is one of the Fed's preferred measures of inflation, increased 0.2% in July, which is a pretty benign number. But where there is some concern is July year over year increased at 3.3%. And that 3.3% is a slight uptick from the 3% year over year increase of June 2023. So if you look, year over year increases in April was 4.3%. It dipped down to 3.8% in May, then dipped down to 3% in June. Now all of a sudden we've had a little bit of an uptick at 3.3%. And obviously even 3.3% from the inflation we've seen over the last 24 months is very benign, but it's still significantly above the Fed's target of 2%.
Yeah, Fed's targeting 2. We're still running in the 3s. We talked about this last month or last couple of months where because of the way they measure inflation, the base numbers from last year, that we'd see lower numbers, these, for June, July, August, but that may start to widen out a little bit as we see these month-over-month numbers, 0.01 or 0.2 times 12. Yeah, we're still well in the 3s and probably high 3s by the end of the year, which means the Fed's going to be diligent. They want 2% on the inflation rate. Will they raise rates again this month? You asked us a month and a half ago, it would have been yes.
I mean, the consensus right now says there's going to be a pause in September.
Correct.
And most likely an increase in November.
Right. So we could still see a little more pressure to the upside with rates, with the unemployment or the employment softening a little bit, maybe reverting back to the mean. That would argue for less need for rate hikes. But, we're kind of in this wait and see period. GDP numbers still look good. Did you have an estimate for 4? I mean, last time they talked about third quarter.
This is where we got a little bit of a problem. No, and we are in that situation, Kelly, and we see it, every several years where it's not necessarily bad information, but mediocre information is good because everybody is concerned about the Fed tightening too much, that taking the U.S. economy into recession. So it's like every time news comes out, everybody's got their fingers crossed that it's just okay. It gives the Fed a reason to pause. And that's kind of what the market is looking for. Again, this Goldilocks situation where, you want an economy that's not too hot and not too cold. So here is the big issue. Everybody, his pundits on Wall Street have been talking about this. This is the GDP Now financial model from the Atlanta Fed. As of September 1st, the Atlanta Fed is now projecting that third quarter GDP will increase at an annualized rate of 5.6%. We're almost at the end of the third quarter, and their model is pretty darn good at predicting these things. They do expect, with information that's coming out over the next 3 weeks, for this number to come down. But still, if we have a high threes, fours, if we have a number in the 5, that really puts the Fed in a tough position. I mean, that's red hot for the U.S. economy.
Correct. I mean, anything growing over 3 is really strong. You see that coming out of recessions. Did we have a recession? Nobody saw it. Who knows? But yeah, we're in interesting times, which I think really stacks up for, more of the same, where just like in August, the market started off really weak, started to pick up some steam towards the end of the month. Now we're into September. August, September historically tend to be, a little more volatile months. Come back after Labor Day, people getting back to work, especially in the investment management world. I think you see a little bit more, volumes picking up in the stock market, in the bond market. So we have to expect some volatility this month. Does that mean it's going to be a negative month? I think we're going to see some negatives and positive by the end of the month. Where do we end up? I'd toss a coin. Is it going to be a positive month or a negative month? We have a little bit of momentum now. I don't see the end of the world happening this month, but it's going to be a choppy month. I think we're kind of marking time. It's going to be choppy. We're going to go back and forth. And the key, like we've been saying for the last 6 months, is, stick with quality. Quality always ultimately works, and especially in times of uncertainty. Don't have too much, whether you're a corporation or an individual, managing your debt loads is very important. Making sure you have the cash flow to cover your debt loads. With what we do with clients' dollars is making sure we have liquidity to be able to get through the rough patches, which so far this year haven't been that bad. But that's we're up still nice year to date.
That's my concern. If you look at it, the increases by the Fed and the Fed funds rate is obviously it's historically unprecedented. But we are seeing, when we talk to clients, when we talk to business owners, they're feeling now those higher interest rates.
Oh, yeah,
and that is
happening.
Cutting back spending. It's cutting back investments on, on new home purchases, on taking out home equity lines of credit to do home remodels. I mean, it is starting to pull money out of the system. And that's what scares me, is we're looking over a precipice, and I'm kind of scared what 3 months from now might look like.
Absolutely. And that's, when you're going through it, it's happening in slow motion. Mm-hmm. You look back historically, the numbers, this happened and it was no big deal, happened quickly, and then we bounced back. But you don't realize the time it took to get to where, to get through a cycle. Mm-hmm. And we're in the middle of that. It's kind of a slog. Realizing the higher interest rates as loans come due or interest rates reset, that takes time. Now it's starting to feed through the whole economy. We're starting to see it. So, it's good that the Fed is pausing. Yep. They could have gone gung-ho, raised this month.
Well, and but
we're going to start seeing it for the rest of the year.
It's two-pronged too, where borrowing costs have increased, real inflation is up, purchasing power is being diminished. People are hurting out there. This feels very much like 2008, 2009, where the consumer's just not comfortable. Confidence index, business investments, it really hasn't come down yet, but there's a sense there that people are starting to say, I don't think anybody's used to these interest rates. It's been so long.
Well, it's been a long time. Consumer confidence is definitely, lower than what it normally is. We've seen that kind of roll over in the last couple of months. How that's related to investments, on the other side of it is, I talked about it earlier, August was a weak month. We didn't end the month as bad as it was earlier in the month, but the S&P for the month was down 1.77%, but still up 17.4% for the year. The Dow down 2.36% for the month, still up 4.75% for the year. NASDAQ down 2.17% for the month, but up 34% for the year. The small caps, measured by the Russell 2000, down 5.17% for the month. Year to date, up 7.86%. On the international front, kind of international had a rougher time. Part of it is the dollar strengthened this month. So the EAFE down 4.1%, year to date up 8.5%. Emerging markets, they had they felt the most pain this month. Once again, really related to the strength of the dollar, down 6.36%, year to date up 2.5%. So emerging markets continue to struggle in a weaker economy. People are less apt to send a bunch of money to smaller economies. They're going to stick with.
And again, that story is just kind of the same thing we talked about in 2022, where you have 5 mega tech stocks that are really pulling the entire NASDAQ and the entire S&P 500. I mean, the divergence in the S&P 500 from the Dow, you typically don't see that big of a break.
No, not 13 or 12% or 12% spread. That's pretty large. And it may come in. It came in a little bit last month, but then last couple days or then the last week kind of gave it a little bit of boost. In our portfolios, our growth with income portfolio for the month down 1.7. Year to date, we're still up 8.2. Big gainers. NVIDIA up 5.6%. At one point, I think it was up over 10% for the month. It gave some back after earnings. Exxon seeing some life and energy up 4.6% for the month. Visa up 3.5% for the month. Laggards, CVS down 12.7, Microchip down 12.4, Nike down 7.9, Lennar down 6. Year to date, our big gainers, NVIDIA once again up 238% for the year. Apple up 45% for the year. Lennar, which was down 6% last month, still up 33% for the year. And then Nucor, pretty good run last month, up 31%. Year to date, CVS down 28%, Raytheon down 13%, Honeywell down 11%. So that's in our growth with income portfolio. Dividend yield is our big dividend payers. Eaton Corp up 12.6%, Cisco Systems up 10%, Caterpillar up 6%. So some good numbers there in a down month. Oh, I'm sorry, the overall portfolio down 0.6%. So almost eked out a gain there. Year to date, it had been lagging. We're up 5.6%. So the more defensive stocks haven't been real strong, but last month, obviously, they worked relative to the rest of the market. Laggards in there, U.S. Bank down 8%, Southern Co. down 5.4%. Big gainers for the year, Eaton up 49%, Blackstone up 47%, LyondellBasell up 24%, Cisco Systems up 23%. Where the portfolios felt pain for the year, Pfizer down 28%, U.S. Bank down 21%, Verizon down 6.5%. Price potential, which is more of a growthy portfolio, year to date down 2.3. I'm sorry, August down 2.3. Year to date up 8.75. Big gainers, Gibraltar Industries up 16, Intuit up 6, Juniper up 5.5, Visa up 3.5. So no big movers in there for the month. Laggards, Columbus McKinnon down 10.9, Corteva down 10.2. And NICE down 10.6. Year to date, still being held in the portfolio. Intuit up 34%, Fiserv up 20%, Visa up 19%. Year to date, we besides what happened last, actually, even the ones that were down last month are still positive year to date. We've been kind of selling out of our losers, so really nothing long-term losses in there year to date, so to speak. In our appreciation with income, up down 2.6% for the month, year to date up only 3%. Kind of once again a little more defensive portfolio. We got some financials in there. Big gainers, Dell up 6%, Bungie up 5.8%, Energy Transfer Partners up 3.9%. What hurt us in there? Dick's Sporting Goods down 20%, which we did end up walking away from. Restaurant Brands down 3.9%, Lamar Advertising down 7.6%. Year to date, our big gainers, Broadcom up 67%, Dell up 43%, Bungie up 17%, JP Morgan up 11%, Bank of America, year to date down 19%, Gilead down 9%. Looking at small cap stocks, for the month, actually positive. The Russell 2000 was down 5.17. We were up 1% for the month. Year to date, we're up 6.3. So we're lagging year to date, had a good last month. Big gainers, Powell Industries up 38%, Sterling Industries up 38.6%, Consolidated Water up 36%, So some big gainers, kind of the usual stuff in our SMID portfolio. Laggers for the month, Sylvamo down 15%. Global Climb Global down 13.2. We did walk on that. And then Covenant Transport down 10%. Year to date, Lantheus, we sold out of that. Year to date, we're up 34%. Total return, we made 170% out of there over the last couple of years that we've owned it. Sterling Infrastructure, year to date, up 144%. Performed Line Products up 105% year to date. Consolidated Water up 80%. Big laggards for the year. RCI Hospitality down 28%, which we did sell out of. Richardson Electronics down 22%. Excel Service down 15%. So, good month for SMID, or for our small cap portfolio. Year to date, making up some ground. Like I said, I kind of expect more of the same this month. Just some choppiness. I think, in general, we're, in the downside, we've been definitely performing better than the indexes, and I like where we're at. It's just, it's a patience thing. We need to stay patient, manage our cash flow for clients. If you have big expenses coming up, please let us know so we can plan for it, or things you see between now and the end of the year where you have large outflows, let us know. Other than that, I think we're positioned well to kind of weather through what we're going to see the next couple of months.
So with that, we'll talk to you again next month. Thank you as always for the trust. Have a great week.
Thank you.